Good day to one and all. This is Dr. Sivaraman of iknowindices.com. I'll be presenting the webinar Asian Session Live Market Analysis now between 5 and 5:45 GMT on 29th October. I'll be giving the forecast for the week 29th October till 2nd of November. This is going to be the month end and the new month beginning trend reversal time. The market is known to be volatile during this particular time frame. So as per the forecast algorithm, I will try to explain to you what could be the possible moves happening in the market based on the derived forecast. So this derived forecast is displayed in my blog iknowindices.com/blog and also in fxtrade.net. On a daily basis, I will try to give the forecast there, what could happen during this particular day. They are all nothing but the guidance based on the statistically derived application, and there can be a variation from that of the expected market moves. In order to fine-tune the expected market moves, we try to do the market reading. So in the market reading, we try to note down the initial low and the high around 3:30 GMT in 4 majors and 2 commodity pairs. So this is the live market code page, which we use it as a tool. In this you come across the 4 majors, Euro, USD Yen, GBP, USD CHF are given, and also the 2 commodity pairs, USD CAD and Australian dollar. So in that you come across the current bid and the ask levels and also high and the low. So this high and the low around 3:30 GMT we make a note on a daily basis and try to find out where the market is staying from time to time during the day, and try to understand what sort of moves they are trying to do it, either going below that of the initial low or going above that of the initial high, or consistently they stay below that of the initial low or above that of the initial high, or they just make a brief downward move below the low and then go up, or a brief upward move above the high and go down. So these type of moves we try to note down. So when you read the type of moves they do it in sequence. So the type of moves is namely the stop and false move, extended move, and the intentional moves. And besides, in between, during the mid sessions, you come across the swings happening between the high and the low. So currently you come across the range is very narrow in the case of Euro and GBP and also in other pairs. So we try to note down the net change also. So what sort of moves they are trying to do is, net change is nothing but the current market level pertaining to that of the previous day close. So previous day happens to be Friday close for us, because we are in the big beginning. So from that of Friday close, Euro is now currently 11 pips lower and USD Yen is 4 pips higher. GBP is 25 pips lower than that of Friday close. And also the GMT time is given. With the help of this, we will be able to note down in which session we are. And the players have got 3 sessions for the day, and those 3 sessions, depending upon the bank opening and the closing, they are trying to make moves in the market. So those sessions are very important for us rather than using our local time. So I insist upon using the GMT time frame because it is a 24 hours market. In this 24 hours market, they systematically make moves during 3 different sessions of the day. I'll explain with the help of another slide. So we try to note down the initial low and the high around 3:30 GMT in 4 majors and 2 commodity pairs, and later on we try to find out what is the type of move they are trying to do it as the day proceeds. And we can come across still our reading can go wrong. As long as we are human, there is a possibility that we can go wrong. So in such a scenario, we have to necessarily preserve our equity. And there is no point in telling that my forecast has come true or it has not happened and things like that. And that may be all right as far as the statements are concerned. But basically what is more important is that we have to preserve our equity and try to see that we don't incur massive loss, or consistently we don't lose money in the market, because it's a hard-earned money. So in order to limit the risk for that of the positions what we have taken and the money which the market could erode from our equity, so we use a basic trading strategy. After understanding the derived forecast and the market reading, we enter and exit only during the quick market moves time. So when the market is expected to make some quick moves, during the session start time of each of the session and the session close time, they will make quick moves in the market, especially in the case of the majors and two commodity pairs. And during the mid sessions, they handle the crosses. So when they are handling the crosses, if you try to take position in majors, probably you may have to wait for a long time. So if you want to quicken the trade to happen in a matter of about 1 or 2 hours and earn money from that market, whenever you come across quick moves in the market, try to enter into the market. And quick moves are false moves in the market. So when they quickly drop and hit the low and go below quickly about 30-40 pips or 50 pips and come quickly and stop cutting the low in 10 to 15 minutes and reverse the market and come above that of the initial low in less than 30 minutes, then we try to take a buy. Either do after that drop, or when they cross above that of the initial low and stay above there for 30 minutes, then we try to take buy. And definitely you'll be able to see that they are going closer to that high, and they may breach the high and go above, or may go up to the low and then make one more dip if needed, if it is happen to be the second session. So this is how we try to enter when there is a quick downward move. We try to buy when there is a quick upward move above that of the high, 30-40 pips, and stop cutting the new high for 10 to 30 minutes, and then reverse. We try to take a sell there, and thereby we'll be able to keep stop at entry in the buy or the sell quickly. And later on, when the market comes down in our way, we try to trail the stop and book profit on the sell side, or trail the stop on the buy side and close the position, exit out of the position at a higher level. So we can use 15 pips trailing stop in profit making position. In our basic trading strategy, what we do is we use the hedging order of 30 pips as soon as the position is taken, and when the position is making loss, we keep the hedging order. When the position start making profit of 15 pips or 20 pips and above, then we keep stop at entry and try to maximize the profit using a trailing stop. So we don't use the stop in a loss making position, because if we use the stop in a loss making position, what happens? The players try to hit the stops most of the time during the session start time, either on the upside or on the downside, and then make the move as per our expectations. So obviously we have to see that we are not stopped out. So many traders feel that it is better to avoid keeping stop, but that is not the solution. In case if they make massive drop, then our equity will erode very quickly and we become stunned. We try to do crisis management. Instead, we use the hedging order to limit the risk, and once the position is hedged, if the market is quite away from us, we can simply close the position with the hedging with the limited loss what we have already determined. So it will not be unlimited loss. In case if we know how to use the hedging for either way trading, then book profit on the hedge side and try to keep another hedging order to limit the risk, and when they start making the move in our favor, start making profit on the buy side also. So that way you try to behave like a short seller with the sell position when the market is coming down, or trying to keep stop at entry and see that how far they are dropping. And when they start reversing the market, you try to do a trade like a buyer and try to maximize the profit on the buy side. So that way you don't become emotional or you don't become biased, and then automatically we know that the market means swings. They have to make up and down moves alternatively, and there is no other go. That is the way they have to make money from that of the market. So understanding all the limitations that because the players have got huge money to make moves in the market. We don't have. But still, understanding the limitations that we have limited resources, still we have to use the entry stop to limit the risk and use stop in profit making position and try to move the limit away from the market, and also the stop trailing stop in the profit making position, thereby we can maximize the profit. So keeping this as objective, we are using the derived forecast and the market reading as a guidance, but we focus on the trading strategy in order to earn money from that other market. You know, there is a saying in the market, a good forecaster may not be a good trader because he fails to use the trading strategy invariably, or he try to determine the support and the resistance and try to keep on the buy side a stop below that of the support and on the sell side above that of the resistance. But the players know very well such stops will be in plenty in the market, and they try to hit the stops and reverse the market. So you find that invariably those who use effectively the trading strategy don't become afraid of the market, and they are able to consistently earn money from that other market. Now, let me go to the second slide and try to give you the forecast expected during this particular week. So today is 29th, so week beginning falls smooth. They have made a dip during the start of the Japanese session, and followed by that we may come across swing and gain moves during that of the European and US sessions. So Euro and GBP are expected to slowly gain the levels during the day. And as I explained, when they are just closer to that of the low or closer to high, only then we think of taking trading positions, not otherwise. Then 30th, tomorrow, a quick rise could be seen during that of the Japanese session, followed by very volatile moves, and they will try to create uncertainty tomorrow. And nowadays, midweek, they used to do midweek the either way stop and moves, but nowadays they are doing on Tuesdays the either way stop ends. They will try to hit the stops above that of the high and try to hit the stops below that of the low alternatively. Then 31st, it is a month end time, so they are expected to make a quick drop during that of the Japanese session, followed by that of a quick rise during that of the European and US sessions for the month end. Then this is mainly to handle the derivative market, the options and the futures. So if you are holding the positions till the last minute in the options and futures or in the binary trades, they try to hit the stops on either side. So that sort of moves, they do it on the month end. You have to be very careful when you are taking positions in the derivative markets, especially on month end time. It is very risky to hold the positions. Then on 1st November, Thursday, that will be the new month beginning time. So slowly they are expected to gain the levels on that particular day. And the second, you know that non-farm payroll is expected to be released on that day. They are expected to make slow swings and volatile moves before the announcement of the non-farm payroll, and they will drop as if the market is going to collapse after the non-farm payroll, and consistent gains they are expected to make after the non-farm payroll announcement. And this rise could be very significant on Friday. Then next week, 5th to 9th November, we could come across the second week. The trending moves could be set, and initially very volatile move and the quick gaining moves are expected before the US elections. Afterwards, they are expected to make some more volatile moves till the results are announced, and later on they are expected to gain more levels in the case of Euro and GBP in this particular, in the coming month, November. So these are all the derived forecast. So there is no guarantee that it has to come true, but still we statistically derive in any statistical analysis with the help of the confidence level. We try to derive what could happen in future, but we don't totally depend on that. Still we try to fine tune it using the market reading. So in the market reading, what we do is Note down the initial lows and the highs in 4 majors and 2 commodity pairs. So euro formed the low 1.2915 around 3:30 GMT and 1.2948. You can see that they are not disturbed, they are not breached. And in the case of GBP, 1.6076 was the initial low, and currently you come across 1.6075 as a new low, and the high was 1.6105. So they cut the low in GBP by 1 pip. So that means they are doing the USD gaining move. Now you can see the denominator currencies are showing green color net change, and the numerator currencies are showing red color net change. That means they are negative. Red means negative, green means positive. So on the whole, the majors and the 2 commodity pairs are making the USD gaining move to start with as a weak beginning false move. Now in the case of yen, 79.60 and 79.75 are the lows and the highs, they are not breached. Only in the case of GBP, they breached the low by 1 pip. Let us see what they intend to do it. If they cut the new low in the case of GBP in next 30 minutes, within next 30 minutes, that means they wanted to go down. And if they are not breaching this new low, and instead they go above that of 1.6076 and stay above there for 30 minutes, that means it was a brief downward stop, and they would have noticed some of the stops around that particular area. And you know that 1.6075 is the low, and in the platforms they add the spread also, 3 to 4 pips or 2 pips, whatever it is, depending upon the type of platform, and they try to hit those stops also. You have to keep it in mind. Even though 1.6075 is the low, if you have a stop around 1.6073, the platform might close it. And if you ask, they will say because of the spread variation. Then in the case of CHF, 93.40 was the low and 93.61 is the high, and they are not breached, so they are making small swings here. In the case of Canadian dollar, 99.78 is the low and 99.96 is the high. They are not breached. See how we are short of 4 pips short of the parity in the case of Canadian dollar, and they are trying to hold it that way. And that is the way they create the uncertainty. In the case of Australian dollar, 1.0345 is the low, 1.0370 is the high, and they are not breached. So you find in the case of commodity pairs about 20 pips net change, whereas in the case of the numerators you find less, excepting GBP. And you know that GBP is the currency which is used as a sentiment creator in the market. They try to create the sentiment by making quick moves in the market, and thereby the traders go with that of the sentiment created and try to take distressed positions. When GBP drops very fast, then immediately traders might take sell position in euro, and it's easy for them to gain the levels in the case of GBP followed by that euro, because volume is relatively less, volume of trade is relatively less in the case of GBP when compared to euro. So in order to induce the traders to take wrong positions, they try to make such moves. So ultimately it is a man-made market, so men have to manipulate the market, only then the people get deceived and commit wrongly. You have to keep it in mind. The next slide. Okay. The expected market moves for today. So swing and firm up moves are expected during that of the Japanese session, and followed by that European session, swing and quick rise may be seen, and initial some volatile moves, uncertainty they could create during the start of the US session for about 1.5 hours, and then continue the rise during the rest of the US session. So quick gains may be seen in all majors and commodity pairs in this particular week. As I explained, that the market timings are very important. Now from yesterday, the daylight saving system is switched off in Europe and UK. So as a result, the market times are changed as far as the European session is concerned. Still, US daylight saving system will be switched off from next week, 4th of November. So till such time, these are all the market timings. 0030 to 7:30 GMT is the Japanese session. From 7:30 to 8 is the gap time. Then 8 to 13 GMT will be the European session. So European session will be shortened by that. And after 4th of November, you will find US session will start by 14:30 GMT, ends by 21:30. Currently it will be 13 to 13:30 GMT will be the gap time. 13:30 to 20:30 is the US session. From next week, you will find 1 hour shift in the US session as well. So you may come across the contrarian moves happening in the market and try to identify the type of moves happening in the market in the respective currency pairs before committing positions. Understand the market well. Don't try to go with it of others saying that market will go up or come down and try to commit. Then you tend to blame others without understanding that they have been talking like that, or the market can go up or come down, but you have not applied your mind and simply followed the herd of traders. So instead, what I suggest is you do some basic analysis and try to get convinced whether you can do a buy and sell trade or a sell and buy trade. Then later on commit positions, but still you try to use the trading strategy of limiting the risk by using hedging order. Thereby you don't incur any big loss in the market, and there is no need that you have to blow out your account 3 to 4 times before you become an expert trader. And see, that is referred as an experienced trader. An experienced trader, what he does, he commit a lot of mistakes and learn out of the mistakes. And it takes a longer time. If he has got enough equity, then probably you can open again and again some more accounts and try to learn out of the bad experience and try to avoid making such mistakes. And you know that normally a person who avoids making mistakes is considered as a sane man. So as long as we are human, we are bound to make mistakes, but later on we should avoid committing such mistakes. So again and again, if you commit such mistakes, that means we are not sane, or it's otherwise called as a foolish approach. So an experienced trader learn out of mistakes, and it becomes a costly affair. And if he has got enough equity, then probably he is able to open one more account and try to earn the last money. But predominant of the traders, when they lose the money, they develop the necessity and the urge to earn back the money so quickly. In the process, they become aggressive trader and become addicted to trading. Once you become addicted to trading, you will not be able to use your common sense. Probably you might be induced to sell some assets and try to invest in the market to get back the money and continue to lose. So if you take any emotional decisions as far as market is concerned, it will be detrimental. So you have to understand that the emotion does not work in market. That is why I always say patience is rewarded in the market. If a person is patient and still use the risk limiting factors calmly and try to understand the market, okay, if the market is not moving as per my expectations, I will avoid taking positions for a few days, especially during the month end and the new month beginning time. They are bound to make volatile moves. Neither bullish nor bearish moves could be seen, and suddenly they may say very bullish, and the very next moment they may say that very bearish, and so you do not want to risk at that time. Avoid taking positions. And during the second, third weeks, they will be setting the trend in that particular month. Then you can commit positions. It is easy to make money. So that sort of decisions are very vital. If you become addicted to trading, then every day as soon as you open the trading platform, you feel like taking the positions, and later on you become impatient with the positions, because as you see that the players continue to hold the market, or sometimes they make big moves in the market, then you become mentally fatigued when the market is subdued. Then you might be thinking, okay, after the data release, the market might make a move, and probably I'll go for a nap because I have been watching for 10 to 20, 15 hours. So let me go for a nap and come back. Once you come back, you would have seen that your stop is hit or the market is quite far away from your expectations. So this sort of surprises could happen. The surprises happen because you presume this is what going to happen in the market. So I always say that expect the unexpected as far as the market is concerned, so that you will not be surprised. As a result, you will be able to handle situations calmly using your common sense. So understand the type of moves they could make in the market and also the market timings, and during gap time they will make quick moves and they are all false moves, and also they make very quick moves during that of the month end and the new month time. This particular week, 29th to 2nd of November, they are expected to make very quick up and down moves, and you can only do swing trades, not position trades. Don't simply take euro position and say that euro will go to 1.32, and it may not happen. They may just go up to 1.30 or 1.3050 and drop it to 1.29 again, and you might become surprised or fatigued and feel restless that I could have booked profit, and that sort of you might repent again and again. So avoid such things to happen in the market, and make an understanding that during the month end and the new month beginning time, they are expected to make very quick volatile moves in the market. So you can only do swing trades. So if you got any questions, you can ask in the question and answer window. I'll be willing to answer to those questions. Okay, there are some questions in the chat. Okay. From FXXXX, GBP has cut the initial low. Yes, they cut the initial low by 1 pip. Subsequently, you find that they are sustaining above that of the initial low for more than about 15 minutes now. So let us see, for 30 minutes they are above that of the initial low. The Solomon Audi. The webinar is being recorded today, so probably you may just listen to the recorded version. Okay. Any other question? Okay, Mohan Kumar has got a question in the question and answer box. How much gain expected in euro today? See, in a given day, they can maximum do about 150 pips net change level. So, if at all they rise 13 pips on the downside, so another 115 plus 13 pips they can gain. And in case if they want to drop, 150 minus 13 could be the low. So, that is a potency the players have got. But we try to avoid the uncertainty by using the algorithm and also the market reading. So we find that they had done only 12 pips negative net change in the case of euro and 22 pips negative net change in the case of GBP. They came down to 26 pips and now 22 pips. So they are above that of the initial low, nearly about 20 minutes now. So probably another 10 minutes, if they are not breaching the new low 1.6075, they are expected to gain. And if there is no quick moves, then the upside will also be limited. You understand that? So the swing might be very nominal between the low and the high. If they breach the low, and then there is a possibility that they can breach the high. That is how they make the moves in the market. Otherwise, they may make swings here. So Once they breach the low and stay below that initial low for more than 30 minutes, then there is a possibility that they can drop further down. So the first cut, suppose 1.6076 is the low in the case of GBP, and they dropped about 20 pips from there. Imagine, I am just giving a theoretical example. So 1.6050 they had dropped it. That means 20 pips they had dropped initially. Then there is the possibility that they could drop up to 60 pips. 3 times of 20 pips they could do. That is a potency. So if they don't do it, the second is only 10 pips, then understand they may stop with that, and later on they could reverse and go above 1.6076 and stay there for 30 minutes, then they could continue to gain. So ultimately you have to understand one thing, what the players are trying to do. They try to hit the stops above that of the high. A lot of stops would have been taken. Players do buy that of the short sellers, thinking that the market will come down. So what the players do is they just go up and hit all the stops there and come down as per the expectations of the trader. But the trader will not have the positions to book profit. You would have been stopped out. Similarly, they go below that of the low and hit all the stops, about 20-30 pips, and then go up. The trader who had taken the long position will assume that it will go up, but before that, if the stop is filled, he is not having any position to profit. This is what happens day in and day out in the market. So in order to avoid, many traders trade without a stop. That is not the solution, because sometimes if they know very well the traders are not keeping stops, and still the traders are long because they get the insider information. What they do is they continuously drop for 2 days. Then the margin call will come for such traders. Because once the loss goes up, he refused to cut the position or refused to hedge also, then you find the margin call comes in. That is how the traders learn once the account is blown up. That is not necessary at all. If you understand that they can rise or drop 150 pips, my equity cannot withstand such pressure, you will automatically use the hedging order to limit the risk. And if you learn, it is very difficult how to handle the hedge if it is hedged. It is something like a person who has taken a sell position and another person has taken a buy position in the same pair. If you use the hedging, there is no additional margin blocked for the buy side as well as the sell side, or any one side. If you have got a buy, and afterwards they hit your hedge order as a sell position, then they don't take additional margin. You can just handle the sell side separately and the buy side separately. If you are smart enough, you should be able to do that. And you should not say that using hedging indicates that you do not know how to trade. No, these are all some of the rude words. They use it in order to discourage traders using the hedging. So today euro is expected to gain about 60 to 90 pips. Then, okay, people are asking questions in the chat window, so I have to look into both the windows. It will be nice if you ask the questions in the question answer window, so that I will focus on one window and try to answer to those questions. Then Salman, howdy. Is it good to hold a trade for a long period? Yeah, if it is a profit-making position, you can hold it for a long time. If it is loss-making position, you hedge and hold it and review the market, whether your hedging is making profit or the original position is making profit consistently. If the hedging is making profit for more than 2 days, then close the other position which is not making profit and maximize the profit in the hedge. Okay, we held a buy for Euro Australian dollar for 3 weeks now, and it is still way down. See, as far as the cross is concerned, you need to understand what the players are trying to do it. And the crosses they handle during the mid sessions, and so they have limited time to handle the crosses. So you have to understand how to trade in crosses. You cannot trade like that of the majors, because in majors the volume is relatively high, the players will try to make up and down moves. But in the case of crosses, they try to make one-sided move. If you are on the wrong side, you may have to for 3 weeks and more. And if without hedging, if you try to try to hold the position for a long time, that might give you the threat for your account. Then Euro GBP cross, will it continue to drop from here? Euro GBP is expected to make a nominal gain, because if you see today, by looking into that of the net change, you can understand which pair they intend to move first. So the pair which is making the less negative net change will move first, namely Euro. Then afterwards Australian dollar, then GBP. So in the process, what they will try to do, they will try to gain more levels in the case of Euro GBP as a weak beginning false move. You find 3 pips positive net change. They could gain up to 80.70 or 80.80 and probably briefly touch 81 if needed to hit the stops, and later on continue to drop from tomorrow or day after tomorrow. So big beginning false move, you have to understand, it's a very, very important information you have to learn. So as soon as you open the platform on a Monday, if you try to commit positions, and it might incur loss, watch the moves and then try to commit positions during the week. You will be able to quickly close it. Then Zulu, what I can use to see the future range of the day. Future range of the day, probably you can just find out whether they are, you note down the initial low and the high. If they go above that of the high and stay there 30 minutes, they can make an extended move for 2 hours above. And if they slowly gain during this, and then you can understand it is an intentional move and they could gain for 2 sessions. And similarly on the downside, if they breach the low and stay below the low for 30 minutes, they could just make the move on the downside. If they slowly dip pip by pip, then I understand they will tend to make an intentional move for two sessions for the day. So European and US session, they may continue to drop. So based on the volume, based on the momentum, they will try to set the lows and the highs. So you have to understand, if they make a quick move on the upside, then they can sustain above that of the high for 2 hours, then reverse the market. So that is extended move. So based on the type of move, you can understand whether they intend to continuously make an intentional move on the upside or the downside, or an extended move and reverse on the upside, from the upside to lower side, or from the lower to upper side. So they cannot continuously weaken or strengthen any currency. They make oscillations in the currency, only then they make money. So for them, making money is more important, not by showing euro at 1.30 or 1.25 and things like that. Then Sam, US equity markets are closed today because of the storm. How will this affect the US FX session? See, FX session, US equity market, spot market and the futures market in the stock. You find not only the US people are participating, even others are participating. But as far as currency market is concerned, it is a global participation. So even though it might be US session, we call it as a US session, it's not necessarily that only US traders are to be there. The other traders can also be there. And sometimes if the volume participation is not there, the market might be subdued. But if others participate in a big number, then you will come across good volatile moves. Is a gold trader, is it possible to use these here? Yes. Slightly modified concepts are used for the commodity markets, because commodity market is localized predominantly, like Hong Kong market, UK market, New York market, etc. Then the volume suddenly go in, come up. So you have to trade according to that of the market timings. Similar to that market timings, what we are using it here for the forex market. But still, the quick moves or false move in any market for that matter. Do you expect contrarian moves in Euro and GBP for this week? Yeah, last week you would have noticed that GBP was gaining. On Friday also, GBP was gaining about 100 pips, whereas Euro was losing. In order to gain the levels, in order to drop the levels from 81 to 80 in the case of Euro GBP. Today you find that Euro is making less drop, GBP is making more drop. So this is mainly to keep Euro relatively strong. As a result, Euro GBP to go up. So in order to handle the crosses like Euro GBP, Euro CHF and GBP CHF, they try to make such contrarian moves. So not all the days they will try to make contrarian moves. On certain days, especially during mid sessions, they are bound to make contrarian moves in Euro and GBP. Then Chow Kiat. You call for USD CAD reach parity. How much? How far it will USD CAD rise from here? Yeah, USD CAD could rise to 1.01 level to start with. They mean normally when they go above that of the parity, they don't sustain at parity. They just go up to 1.0025 or 30 and make one drop to just 25 pips below that of the parity and then go up straight to 1.01 level. That's the way they make it. So you have to understand the behavior of the players in order to understand the behavior of the currency, because it's a man-made market. So the behavior of the player is more important rather than simply giving an attribute. It is a behavior of the currency, because the currency cannot move on its own. It depends upon the people who participate, and the people who participate with big volume are players. Then FX, XX, are they doing an upward or a downward stop today? Today a brief downward stop and followed by that swing and gain moves are expected, as I explained in this chart. More than 2 hours market stay above high and breach the high in third or the fourth hour means what can we do at that time? Okay, you have to understand first of all whether they are making slow gain or a quick gain. In the first 2 hours, if they slowly gain, understand they wanted to make further gains as an intentional move. If they quickly cut the high in fraction of a second and then hold, understand they wanted to reverse. On Friday, you would have noticed that Euro, they took it up to 1.2958 and things like that very quickly started making a dip. So you have to understand the difference between the quick and the slow moves in a market. That can be achieved or learned very well by using the live market port page. It may not be well reflected in the charts. In the charts you might come across the green candle, a spike and things like that, and invariably you go in for the candle study, fail to understand what the type of moves they are trying to make it. Okay, now in the question answer window, Mohan Kumar, okay, same question is asked there. I answered it. So any more questions? Okay, fine. So I'll show the last slide. Okay. So I take this opportunity to thank FX Trade and also you people who have come here to listen to my webinar. And I'll come back again on Thursday, November 1st, the month beginning, and take another session of Asian Session Live Market Analysis. During that, I will review the call given today and see how exactly the market has behaved, and we will be able to see how month end is really bringing in unexpected volatile moves, and continue to analyze for that particular day, Thursday, and also for the next day, weekend, and try to give the fine-tuned forecast what could happen before and after non-farm payroll release. So we will meet on Thursday. Until then, you can just see daily market forecast in inoindices.com/blog, and also same is repeated in fxtrade.net. There you can get the daily forecast. So thank you one and all. See you on Thursday.